and which is also known as accounting rate of return. And we discuss the advantages and disadvantages of the accounting rate of return. So first of all, if uh, you student have any question from the last lecture, if you have any problem regarding the topic of ROI, loss, or accounting rate of return, you can ask the question. Otherwise, we will continue with another method of investment appraisal. So do you have any question? So we continue with the new method. Okay, I think we have no. Yes, any question? Okay, so let's continue with the new topic, a new method of investment appraisal. Just give me a minute. Okay. So the next investment appraisal method is a payback period. Payback period. A payback period, first of all, is a cash based method of investment appraisal. The accounting rate of return was not a cash based method. That was a profit based method. Payback period is a cash based method, first of all. And if we define the payback period, if we define this method, payback period, it's a time taken to recover initial investment. It's a time taken to recover initial investment. Like for example, if we assume that our initial investment is $100,000 and our annual net cash inflows are $20,000. And for a time being, if we assume that these annual cash flow will remain same over the period, then to recover $100,000, our project is going to take initial investment 100,000 and annual cash flows are 20,000. That means the project is going to take 5 years to recover the initial cost, payback period. And the decision rule here, according to payback periods, we will select the project if payback is less than the target set by the company. Now, if company has set a target of 6 years and our project is going to take 5 years, then according to payback, obviously we are going to do that project. And if our payback period is 5 years and the target set by the company is 4 years, then we will not select the project. So if payback is less than the target, we will select it. And payback by its nature should be minimum, because investor always wants to recover its initial cost as soon as possible. That is the principle behind the payback. Now, in this example, we have assumed that annual cash flow would be $20,000. But as you know, that in many cases, the cash flows would not be same on annual basis. And in that case, if we have to calculate the payback, then how we will calculate it? Now let's do another example. Another example of payback period. Let's say, again, we have an initial investment, or you can say the initial cost, and that initial cost, let's say, is $200,000, and our annual cash inflows in year 1, year 2, year 3, year 4, year 5, year 6, and year 7. Let's say we have 7 years project life. Now, in year 1, we expect to recover 40,000. In year 2, we expect to recover 55. In year 3, we expect to recover 70,000. In year 4, we expect to recover 60,000. In year 5, we expect to recover 20,000, then 15,000, and in year 5, in year 7, let's say in a year 7, we expect to recover only, let's say, $10, only $10. Now, if in such situation, I have to calculate the payback, where the annual cash flows are not same, then how we will calculate it? Now, that would be very easy. In year 0, we have 200,000 in a form of cash outflow, 200,000 initial investment. Now, in year 1, we expect to recover 40,000. So if we recover 40,000, the remaining amount will be $60,000. Will be, sorry, 160,000. 160,000. Then in year 2, we expect 55,000. So remaining investment to be recovered will be 1,05,000. And then in year 3, we have 70,000. And remaining balance to be recovered is 35,000. Now in year 4, you have annual net cash inflow 60,000, which is more than 35,000. That means our payback period will be 3 years and some months. So now we have unrecovered investment of 35,000. And in year 4, the cash inflow is 60,000. So if we divide 35,000 by 60,000, the answer will be Answer will be 0.58. So we can write our payback period is 3.58 years. Or alternatively, you can also write the payback period is 3 years, and now if you multiply 0.58 with 12 months, in months it is 7 answer. So you can also write 3 years and 7 months as your payback period. 3.58 or 3 years and 7 months. Both have the same meaning. Now, if this payback period is less than our target, then obviously we are going to select the product. Got it? Students, you got it? Any question? Can you hear me, students? Can you hear me?
Yes.
So, do you have any question?
No.
Okay. So that is the payback period. Now, let's discuss the advantages and disadvantages of this method. Advantages of payback. The first advantage of the payback is it's a cash-based method. It is the first advantage of payback period. The second advantage is it's reduce the risks with investment. Now, payback reduce the risk which we have in a investment or in a project. How it reduce the risk? If we are using the payback period, then obviously we will select the project which has minimum payback, short payback. And if you have short payback, obviously the business risk, the financial risk which we have in a project, that would be much less. So it helps to reduce the risk in a project or risk with the projects. Number three, it's very useful in capital rationing. The payback period is useful in capital rationing for investment decision. Now, what is capital rationing? Dear student, capital rationing is a situation where you have number of profitable projects. You have numbers of profitable projects, but you have no sufficient funds which requires to invest in all those projects. Now, that situation is known as capital rationing. For example, you have 4 projects which require total $5 million, but you have only $4 million. Now, this situation is known as capital rationing. Now, payback period is useful in capital rationing. How it is useful? Because in payback, you will select those projects which have short payback, which has minimum payback. So when your payback period is short, you are selecting those projects which have minimum payback, which have less payback. So that means the money will come back with a return soon. So when the money will return back, so you can reinvest those cash flows in other projects which you are not able to invest earlier. So that's why the payback period is also useful in the capital rationing situation. And number 4, it's also used as screening tool in investment appraisal. Now, how we use it as a screening tool? Many managements use the payback period to, to, to screening purpose that which project should be done and which project should not be done. So if any project fails this criteria, they does not apply other methods or other methodologies to decide that whether that project should be accepted or not. So it is also used as a screening device to set aside the project which company does not want to do. So these are some advantages of payback period, but it also has some disadvantages as well. And what are the disadvantages? The first disadvantage is about time value for money. The payback period does not consider the time value for money, does not account for cash flows as per their present value. The payback which we have discussed, it does not consider the time value for money. It does not discount the cash flow. It does not consider the present value of the cash flow. Like in my example, I taken the cash flows, but I taken them at a future value. I didn't discount these cash flows to the present value. So this payback period is not considering the time value for money. Number two, the second disadvantage of this payback is it does not consider the whole project. The payback period does not consider the whole project, whole life of the project. Like in my example, I consider only cash flows up to 4 years. And when I have completed my payback, I didn't consider the cash flows which are arising after the payback period. Now, this is a problem because subsequent cash flows may be much lesser than earlier years. Like after 4 years, we have significant decline in a cash flow, 20, 15, and then 10. So we should use a appraisal method which consider the total life of the project, not limited life. Now in payback period, we are just considering the life of the project up to the payback period. What are the cash flows after the payback period? We are not considering in this method. It is then second disadvantage of this payback period, It does not consider the time value of the money. It does not consider the whole life of the project. And the third disadvantage is it leads towards the short-termism. If we are using the payback period to appraise the project, obviously we will select those projects which have lesser payback, which cover the initial investment earlier. So if we focusing on earlier recovery of the project, then obviously we will select the project which have short-term life. Now, short-term life means low risk, less risk. Less risk means less return. So for a business, it is not a good thing that our focus is totally on short-term. We should also invest in those projects which are long-term, which are some risky investments. So we can make high returns as well. But payback period is taking us towards only short-termism. It is not considering the long-term objectives of the organization. Okay. And another very general disadvantage of the payback period is that payback period does not consider the size of the project. Like for example, If I have a payback, I have two projects and I have to select only one project and they are mutually exclusive projects. Now let's say a project A has a payback period of 4 years and project B has a payback period of 7 years. Project A has a 4 years and B has a 7 years. Tell me, according to payback, which project you would select, project A or project B? Yes, please respond. Which project you will consider as per the payback? A project with a 4 year payback or a project with a 7 years payback? Yes, students. A project with a 4 year or a project with a 7 years? Which project you will select as per the payback? Four years. So yes, obviously we will select the 4 years because in payback, our focus in a payback period which is lesser than the other. Obviously, we will select the project with the 4 years. But now, what will be your reaction if I told you that a project with a 4 year has an annual cash inflow of $1,000 and project with a 7 year payback has an annual cash inflow of $30,000? Now you will rethink and you would be thinking that you have selected a wrong project because size of the project is much lesser than the size of the project B. In absolute term, the project B is giving you a greater return of $25,000-$30,000 as compared to project A, which has only $1,000 return. So now you will rethink again, and now you would say the project B should be selected. Other things remain constant. You would recommend that project B should be selected. Now that means the payback period does not consider the size of the project. The payback period cannot be related with the shareholder wealth maximization. 4 years payback doesn't mean the shareholder wealth is going to maximize. For that, we need answer in dollar terms. And payback period does not provide us the answer in dollar terms. So it ignores the size of the project as. It is another very important disadvantage of payback. So payback does not consider the time value for money. It does not consider the whole life of the project. It leads us towards short-termism, and it does not consider the absolute size of the project. Absolute size of the project. So these are some disadvantages of payback. Now, do you have any question?
No.
Are you getting the points?
Yes.
Okay. Everyone? Okay, now let's attempt a quiz. To read the question number 1, which of the following statement concerning the payback method is correct? Which statement concerning the payback is correct? Yes, option A seems to be a correct option. Now, in considering the payback period of 3 projects, Fly Company gathered the following data about cash flow. Project A, Project B, and Project C. Now the question is, now the question is, which project will achieve payback within 3 years? Yes. Which project will achieve payback within 3 years? The project A would not achieve payback in 3 years because in year one it is 1,000 outflow, then year two 3,000, and year three 3,000. So in 3 years it is still have a negative cash of 4,000. So project A is not the answer. So the option A and option D cannot be the answer. Option A and option D cannot be the answer. Now we're left with the B and C. Now the project B has an annual year one cash outflow of 25. And in year two and year three, it has 15,000, 15,000. So the project B is recovering its investment in 3 years. Within 3 years, it will become positive with 5,000 cash flow. And same goes with the project C. The project C is also recovering its negative cash flow within 3 years. Within 3 years. Are you getting it? Project B and C is covering its investment within 3 years. So the answer should be, I think answer should be B and C. Option with project B and project C only. So option B should be the answer. Do you agree?
Yes.
Okay. Now, which investment appraisal method is most likely to result in maximization of shareholder wealth? Okay, let me tell you the answer. Obviously, payback period and return on capital employed are not the method which consider the time value, consider the shareholder wealth. And similarly, IRR is also not. Payback and return, raw speed, return on capital employed, we have discussed the disadvantages of these two methods. And they have common disadvantage that they does not consider the size of the investment. Similarly, IRR also does not consider it. Yes, let me tell you the answer of this question. NPV is the method which consider the wealth of the shareholder. So the project D, I would select. Okay, the option D, I would select the NPV. We will discuss each and every method, but answer is the option D, NPV. Now you need to calculate the answer. I'm waiting for your answer. What is the average investment to be included in the calculation of ROS? You need to calculate average investment. Please tell me, what is the average investment? So option B is the answer. Okay. So initial investment is 340. And residual value is 55. divided by 2. 197.5. Yes, option B should be the answer. Now, which of the following is not an advantage of ROS, method of investment appraisal? It based on profit rather than cash flows. It is simple and understandable. It uses readily available accounting information. It is often used by financial analysts to appraise performance. So, what is not the disadvantage? Which of the following is not an advantage? Yes, option A is the answer. To be based on profit is not the advantage. It is basically a disadvantage. So, option A. Okay, congratulations. You have 100% result of this quiz. Okay. Now, this is the advantage of ACCA Study Hub, that if you are using the Study Hub, you complete the topic and you have readily available quiz which you can attempt and you can verify that where you are standing in that topic. And it is very useful for the student. And one another very important thing, it is also conducting an analysis that how much you have taken a time to answer. So you have attempted these 5 questions within 1 minute and 26 seconds. And it also telling you that how much you have taken a time to answer the correct question, correct answer. And that is also 1 minute and 26 seconds. So it is very useful information for the student. Okay. Now moving forward, we have discussed 2 methods of investment appraisal. Now we have completed the chapter number 3. Now we are moving towards chapter number 4. In chapter number 4, we are going to discuss the discounted cash flow techniques. We are going to use discounted cash flow techniques to appraise the project. And when we say a discounted approach, that means the approaches which use the time value for money, concept to the appraisal of the project. And the first technique which we have is discounted payback period. Now, in discounted payback, we use the discounted cash flow to appraise or to decide whether the project should be accepted or not. Now, taking the same example in which we have initial cost of 200,000, and then year 1, year 2, year 3, year 4, year 5, year 6, and year 7. And the net cash of year 1 were 40,000, I think. Year 2 were 55,000. Year 3 were 70, then 60,000, then 20,000, then 15,000, and then $10 off. Now, in a discounted payback period, we use the discounted cash flow. And to calculate the discounted cash flows, we need a cost of capital. We need a cost of capital to discount the cash flows. And let's say we assume the cost of capital of the company is 10%. Is 10%. Now what we will do, we use the discount factor, which is 1 plus R raised to power minus N. It is a discount factor, formula for discount factor. R is the cost of capital and N is the number of periods. Using this factor, we can calculate the present value of the cash flow. Now, if we use this method to calculate the discount factor for first year, it will be 1 plus 10% raised to power minus 1. And the discount factor will be 0.909. Similarly, if we use it for second year, it would be 1 plus 10% raised to power minus 2. And if you calculate using the calculator, it will be 0.826. Similarly, for year 3, 0.751. Then 0.683 for the year 4. And for year 5, it will be 1.1 raised to power 0.620. And for year 6, it will be 0.564. And for year 7, it will be 0.514. These are the discount factors at the rate of 10%. And they are used to discount the cash flow to the present value. Now, the present value means the value at today term, at current term, when we are investing this $200,000. So now if you calculate the present value, so the first year present value will be 40,000 into 0.909, it would be 36360. For year 2, 55,000 into 0.826, 45,000 430. Then for year 3, 70,000 into 0.751. It would be 52,570. And then 60,000 into 0.683. It would be 58,980. No, just over 60,000 into 0.683. And that will be 40,980. And then for year 5, 15,000 into 0.564. It is 84,060. And then 5.14 for year 7. Now, here you have discounted the future cash flow. Future cash flow of year 1, year 2, year 3, year 4, year 5, year 6, and year 7 to the present value. Present value means the value at current terms, current price term. Value at time zero. Value at time zero is known as time present value. Now we will calculate again the payback using the discounted cash flow. Now our again same methodology will be adopted. Our investment is $200,000. But this time, year 1 cash flow will be 36360. So the remaining will be 1,63,640. Then year 2 will be 45,430. And the remaining will be 1,18,210. Remaining investment. Then year 3 is 52,000. And 570. And the remaining will be 5 to 570. The remaining will be 66,000. Sorry, 65,000. 640. And then year 4, the year 4 cash flow is 58,980. 58,980. And the remaining will be 58,980. The remaining would be 66,660. And then year 5. Then in year 5, you have 8460. So that means in year 5, you are recovering your investment. And the payback period will be 660 divided by 84 and 60. Divided by 84 and 60. 0.79. So we can say the payback period is 4.79 years, or alternatively you can say 4 years and 9 months. To convert it in months, you need to multiply it with 12 and you will get 9.4 months. So 4.79 years or 4 years and 9 months would be the payback period. Now, discounted payback is always greater than the simple payback period because in discounted payback, we are using the discounted cash flows method to calculate the payback period. So this is another method, and the advantage of the payback period is that payback period is considering the time value for money. In simple payback, it was a disadvantage that was not considering the time value for money. In a discounted payback, we will consider it in an advantage that discounted payback is considering the time value for money. Got it? Other advantages and disadvantages will remain same. Other advantages and disadvantages will remain same. Any question? Yes, students, any question? Okay, okay. So you people are getting the point. So we have discussed the simple payback, and now we have discussed the discounted payback period. Now, the next method which we are going to discuss is net present value method, which is NPV. In NPV, we just compare the present value of cash inflows at company cost of capital minus present value of cash outflow at company cost of capital. And if the answer is positive, that means the present value of the cash inflow is greater than the present value of the cash outflow, then the NPV will be positive and we will accept the project. We will accept the project. Positive NPV means it will create more shareholder wealth. Now, this methodology, which I have defined, is known as NPV. Obviously, it is not that simple. We need to discuss it in very detail, and I'm going to discuss it in very detail. But before I start this NPV method, we will take a short break. It's been an hour. So we are going to take a short break, take a break for 10 minutes. And after that 10 minutes break, I will discuss in detail that how we will calculate NPV. This is a simple formula that present value of cash inflows minus present value of cash outflow. But in detail, how we will calculate it, we will discuss this, but after the break for 10 minutes, take a break, and after the break, we will resume the class. Okay, hi student, welcome back. Okay, now we will discuss in detail that how to calculate the net present value. Now, first of all, net present value is one of the most favorite area which examiner usually test in a section C of the exam in a constructive response question. So that means you will get a detailed question on the calculation of net present value. And I will discuss that how we will calculate the NPV using the spreadsheet option. Now I will use the Excel sheet to make you understand that how we are going to calculate the NPV. Now in NPV, first of all, we have the year. Now year means that how many years we have for the project in a question. It will start from the year 0, that is today. And let's assume the project is of 4 years. I'm assuming for this performer that the project will be of 4 years. Now, first of all, we will take the initial cost of the project, and it will be taken in a year 0. Our assumption in the NPV is that so the project will be started immediately and will be completed immediately. And our initial investment, let's say, is in dollar terms, that is $10,000, and we are taking 30 common for the calculation of this performance. In our all calculation, 30 will be considered common. And our initial cost will be taken in year 0 all. Year 0 means today, when we are considering to start the project. Then we will take the sale, or you can say cash receipts of sale. Now, how we will calculate? Now, keep in mind, you will be given with a question. In that question, it will be given that how many units will be produced and would be sold in year 1, year 2, year 3, and year 4. Now, let's say I am assuming with 30 common that the number of units, let's say, which would be sold in year 1, let's say, would be 10,000 units, and their sale price per unit, let's say, is $4. $4 is the sale price per unit. Now keep one thing in mind, that the sale price which will be given in a question will be in a current price term. Now, in a current price term means that inflation would not be incorporated in a given sale price. Now you need to incorporate the inflation as well. For that purpose, you will multiply it with 1 plus inflation rate that would be in a question. Now let's say the inflation rate is 5%. So we will multiply it with 1.05. 1.05 means 1 plus 5%, or you can write it as 1 plus 5%. 1 plus 5% or 1.05. And you will then press the enter, and your sale revenue will be 42,000. Number of units into sale price per unit into 1 plus inflation rate. Similarly, it will be also given in the question. Let's say 8,000 units would be sold, would be sold or would be sold in year 2. And the sale price for these units would be, let's say, $5, again in a current price term. Now, sale price could be same or it could be changed on yearly basis. Now, in a year 2, they have estimated that the sale price would be $5, but again, it will be given in a current price term, and you have to multiply it again with the inflation rate of 5%. But this time, you will take the power 2 because it is second year. Basically, formula is units into sale price into 1 plus G, which is inflation, raised to power n. So for second year, we will take raised to power 2, and this would be our sale revenue for year 2. Then similarly, let's say in year 3, we estimated that we would sell 5,000 units, and sale price would be, let's say, $6. But again, it is in a current price term. So again, it will be multiplied by with 1 plus 5%, which is 1.05, and raised to power 3 this time. Then in year 4, we have estimated that the unit sale would be 3,000, and let's say sale price in a year 4 will be 6,000, and into 1 plus inflation rate 1.05 raised to power 4. So this will be how we will calculate the sale or cash receipt of it. The formula which we have used here is basically units into sale price per unit into 1 plus G raised to power n. Units will be given in a question, sale price per unit will be given in a question, but that would be in a current price term. 1 plus G is inflation, which is 5%, and n is the number of periods. For year 1, it will be 1, year 2 for year 2, year 3, it will be year 3, and in year 4, n will be the 4. So this formula basically I have used to calculate the sale or cash receipt from the sale. Now, after that, we will take the variable cost. Now, for variable cost, again, we will take equal, but this time we will take it in minus. And we will take the number of units produced. Now, in our paper, number of units produced and number of units sold are same. So 10,000 units we have produced and sold, so it will be taken 10,000. And then it will be multiplied by the variable cost with variable cost. And let's say the variable cost is 2.5 per unit. And then it is also in a current price term. And then it will be multiplied by the inflation rate of the variable cost. And the inflation rate can be different from the sale price for variable cost. And let's say the inflation rate is 4%, so 1.04. So that would be the variable cost of year 1. Then in year 2, we have 8,000 units. And let's say variable cost is $2.5 again.
and inflation rate is 4%, so 1.04, but this time raised to power 2. Basically, this same formula is used for variable cost, but instead of taking the sale price, we are taking variable cost per unit. Just that is the difference. Now, for year 3, equal minus 5,000 into 2.5. Again, I'm assuming the variable cost will remain the same. And inflation rate is 4%, so 1.04, and this time raised to power 3. And in year 4, we have produced 3,000 units. 3,000 into 2.5. Because it is cost, so I am putting the negative sign. Into 1.04, and this time raised to power 4. So that is the variable cost, that how we will calculate. Now, sale minus variable cost is contribution. So you can take the difference. For that, you take equal sum bracket, select the cells. You will get the contribution for year 1, and then you just copy paste the formula by dragging the cursor, and you will get the contribution of year 1, 2, 3, and 4. Now, after contribution, we will take the incremental fixed cost. Incremental fixed cost. Now, fixed costs are of 2 types. One is the existing fixed cost, generally administrative overhead. Now, in the existing fixed cost is an irrelevant cost. That cost we does not consider in NPV. Yes, the incremental fixed cost, which is due to the project, will be selected. And fixed cost is a cost which will remain constant in all level of activities, except for the inflation. If there would be any change in the fixed cost, that would be the inflation. Otherwise, level of activity does not impact the value of the fixed cost. Now, that fixed cost will be given in a question. And that fixed cost, which would be given in a question, let's say that is $9,000. $9,000. But again, it is again maybe in current price term. So you have to multiply it with the given inflation rate. And we are assuming, I am assuming that for fixed cost, inflation rate is 6%. So 9,000 into 1.06. Then again, 9,000 into 1.06 raised to power 2. Then again, 9,000 into 1.06 raised to power 3. Then again, 9,000 into 1.06 raised to power 4. So that would be the incremental fixed cost, and this is how we will consider it in the performer of NPV, performer of the NPV. And that is the exact performer which we will be using to calculate NPV in a given cluster. After the incremental fixed cost, you will net it, and you will have a cash flow before tax. And again, equal sum, you will open the bracket, and you will select the contribution and incremental fixed cost, and you have a cash flow before tax. So you have arrived at cash flow before tax in NPV performance. Now, after that, you will apply the tax rate. And let's say the tax rate is 30%. Tax rate is 30%. Now, when we will calculate the tax, Now, when we calculate the tax, which is 30%, there are two possible assumptions regarding the tax. The first assumption is that the tax is payable in a same year, of cash, or it is payable with 12 months delay. Now, whatever assumption we need to use, that assumption will be given in a question. Same year or with 12 months delay. Now, if the tax is in a same year, then the tax relating to the year one cash flow will be paid in year one. Year two cash flow tax will be paid in year two. Tax relating to year three cash flow will be paid in year three. And tax four relating to year four will be paid in year three. But if we have the situation where the tax is payable with 12 months delay, in that case, the cash flow relating to year one will be paid in year two, relating to year two will be paid in year three, and relating to year four, the tax will be paid in year five. Now, I assume that in my pro forma, tax is payable with 12 months wait. I'm using the second assumption, but this assumption will be mentioned in a question. So in that case, the tax relating to first year cash flow will be paid in year two. And the tax relating to year two cash flow will be paid in year three. And relating to year three will be paid in year four. And relating to year four, the tax will be paid in year five. The 523 is the 30% of 1743. You can check, if you take the 30% of 1743, it will be 523. The 2985 is 30% of 9949. 3707 is 30% of 12356. And 1938 is 30% of 6460. In this table, I am using the 12-month assumption with regard to the payment of taxes. You are getting it? This is the pro forma which we use to calculate the NP. Now, after the tax, if you have got the concept till here, now after the tax, we will take in a pro forma is capital allowance. Now, what is capital allowance? Capital allowance is a tax relief on taxable depreciation. Tax relief on a taxable depreciation is a capital allowance. And capital allowance is usually in F9 paper, in financial management paper, is calculated on initial cost. And for the calculation of capital allowance, information again will be provided in a question. That, for example, the tax authority is giving us capital allowance at 25% reducing balance method. Now, for that purpose, we make a working which is year, then the carrying value, then the depreciation, and then the tax impact on that depreciation. Now, like, for example, in year one, the carrying value is $10,000. $10,000. The carrying value of the asset is 10,000, which is initial investment. And it would be told in a question that the tax authorities are providing tax relief on 25%. I'm assuming 25% reducing balance method. So you will take the 25% of 10,000 and your tax allowable depreciation is 2,500. Now on this 2,500, the company will get a tax relief according to 30%, which is our tax rate. Now this 750, this tax column is basically a tax relief, and it will be taken in a performance as per the tax assumption. Now 750 is relating to year one, but it will be available in a second year because we are assuming that tax impact with 12 months delay, So that is the year one tax relief. Then in a year two, the carrying value of the asset will be 7,500. And again, you will take the 30% of 7,500, which is 1,875. 25% of 7,500. 7,500 will be multiplied by 25%. So you have a taxable depreciation of 1,875. And on 1,875, you will apply the 30%. So the second year tax relief, which you will claim in a year three, will be 562.5. If you round it, it would be 563. If you round it, it is 563. Then in a year three, carrying value would be 5,625. And again, you will take the 25% of the carrying value, and then you will take 30% of the depreciation, and you have a tax relief of 422 of year three, but obviously you will claim it in year four with 12 months delay. Now in a fourth year, again, you will determine the carrying value, which is 4,219. 4,219. Now, in a year four, before you take the depreciation, just remember, you will be given with the residual value of the project, or you can say disposal value of the project. And let's say that disposal value is 2,000. You will take the 2,000 here, that is the disposal value. But now in year four, when you are going to calculate the taxable depreciation, now in the last year, instead of calculating the taxable depreciation, we will calculate the gain or loss on disposal. Gain or loss on disposal. Now, our scrap value of the project is 2,000 at the end of the fourth year. Now, the tax written down carrying value is 4,219 and scrap value of the project is 2,000. So we have a loss on the asset, which is 2,219. This is a loss on the disposal of the asset. In tax language, it is also known as balancing allowance. It is also known as balancing allowance. And gain on disposal is known as balancing charge. And this is the allowance. This is a loss. Because sale proceeds are less than the tax written down value. Now in the last year, you will take the 30% tax relief on a loss on disposal. 30%. Which is 666, and that tax relief relating to year four, but it will be claimed in a year five. So after the cash flow before tax, we will take a tax in same year or with 12 months delay. And after that, we will take a capital allowance. Capital allowance is a tax relief on a taxable depreciation. Like here, I assume that in a question, it is told that tax liable depreciation is 25% on reducing balance basis. So we are taking the depreciation and we are applying a 30% tax rate, and we are getting the tax relief. Year 1 relief in a year 2, year 2 relief in a year 3, and year 3 relief in a year 4, according to the tax working. And in the last year, instead of taking depreciation, I will take the sale proceed and I will compare the carrying value with the sale proceed. And if the carrying value is more than the sale proceed, we have a loss on disposal, which is known as balancing allowance as well. On that balancing allowance, again, we will take a tax relief, which will be claimed. That is a tax relief of year 4, but it will be claimed in a year 5. And then we have taken the sale proceeds. And this value will also be given in a question. Okay? Now, doing all these things, the last adjustment which we would have to do is about working capital. Working capital adjustment. Now, working capital means the amount of the capital which we need to run the operations of the company, like to support the sale, credit sale, to support the inventory levels, to support to pay the trade payables on time. That amount of capital is known as working capital. Now, this working capital is usually required from the start of the year. Now, it would be told in a question about the working capital. I'm talking about the working capital that from the start of each year, like from the start of year 1, start of year 2, start of year 3, and start of year 4. The working capital we require in the start of the year 1, we require 1,000. Then we require 1,200. Then we require 300. And in year 4, we require 1,500 working capital. This value will be given, but this value will be given that we required this amount at the start of the year. Now, in NPV table, the start of the year is considered as the end of the previous year. Start of the year is considered as the end of the previous year. Now, like here, in a question, we have been given the information that we need 1,000 working capital in the start of year 1. The start of the year 1 is the year 0. It will be taken in year 0. Start of the year will be considered the end of the previous year. And then in the start of the year 2, we need total 1,200 working capital. Now, we need 1,200 working capital, but this is the total amount. Basically, working capital is increasing by 200. 1,000 is already invested. So when we say we need 1,200, that means we need further 200 from the start of the year 2. But the start of the year 2 will be considered end of year 1. So 1,200, it becomes total 1,200 in year 2. Then in a year 3 start, at the start of the year 3, you need 1,300, means 100 extra. We need 100 extra, but at the start of the year 3, and start of the year 3 will be considered as the end of the year 2. Then at the start of the year 4, we need 1,500. That means extra 200. But this amount we need at the start of the year 4, and start of the year 4 will be considered end of the year 3. And now we are at the last year of the project. Fourth year is the last year of the project. The fifth year is a tax year. But the project last year is year 4. Now, the characteristic of working capital is that when we need a working capital, we invest the amount in a business. But at the end of the project, when the business is wind up, we assume the amount which we have invested in working capital trade receivable will be recovered. So till the year 3, we have invested total $1,500 in a working capital. Now, assumption is that this working capital will be recovered at the end of the project. So we will take it, the total value as an inflow in the end of the project. So that would be the typical adjustment of working capital which will be required in the calculation of the NPV. At the start of the year 1, we need, and 1,000 amount, we will take it in a year 0. Then at the start of the year 2, we need total 1,200. So start of the year 2 is the end of the year 1. So we increase the working capital by 200. We take another outflow. Then at the start of the year 3, we need 1,300. So third year start means end of the year 2. Further 100 and so on. And the last year of the project, which is the end of the 4th year, and end of the 4th year will be considered the 4th year. The total working capital which we have invested, we will taken it back as inflow. Now, after doing all this calculation, we have finally the net cash. Net cash in year 0 is 11,000. And in year 1, it is the sum of cash flow before tax till the working capital. And then you will just copy paste the formula and you have the following net cash in this question till year 5. These are the net cash at the end of the project. Now, let's assume the company cost of capital is 12%. Now, we need to calculate the NP, net present value. Now, how we will calculate the net present value in the Excel format? In an exam, you will press the equal. You will write the function of NPV, comma, and select cash flows, net cash flows from year 1. From year 1, not from year 0. So you will select the cash flows from year 1 to year 5. Close the bracket and minus the initial investment, which is 11,000, and you have a net present value of 9,897, and it's a positive net present value. It's a positive net present value. So our decision would be that we should select this project. How we have calculated the NPV? Equal NPV bracket 12%, which is the cost of capital, comma, select the cash flow from year 1 to year 5, close the equation with the bracket, and minus the initial investment, which is 11,000 in total, and you get a positive NPV of 9,898. And if you have a positive NPV, you will select the project. So this is how we will use or we will apply the NPV concept to determine the NPV of the project. And this is how we will be doing this question in the exam. And this is the exact format which we will be using in the exact. It is a comprehensive format of NPV in all in every aspect, in every aspect. Whatever question we have an NPV, we can solve it using this formula. Any question about the technicality? We will do the question from the kit and we will be having a better understanding. But this will be the performer, and exactly in that way, we will be using the performer to calculate the NPV. Got it? Any question? Now, there are certain items which we do not include in the calculation of NPV. Number one, do not include the accounting depreciation in the calculation of NPV. Because accounting depreciation is a non-cash expense. And NPV is a cash flow based method. It is a cash based method. So we does not include non-cash expenses, non-cash income. So accounting depreciation should not be used in the calculation. Number two, which we should not include in NPV is interest payments on debt. Interest payments on debt should also not included in the NPV formula, because interest payments are already adjusted in the cost of capital of 12%. So we do not include in the NPV format. So interest payment should not be adjusted in the calculation of NPV. Number three, we should not include general and administrative overheads. General and administrative overheads should not be included as well in the calculation of the NPV, because general and administrative overheads are fixed costs which are not incremental in nature and they are irrelevant. So those irrelevant costs should also not included in the NPV or in the calculation of the NPV. Basically, irrelevant costs should not be included in the calculation of the NPV because NPV is a decision making. So remember, interest payment, depreciation, and administrative overhead, which are existing fixed costs, should not be adjusted in the NPV format. If we include these things, then the NPV would not be the correct NPV. That would not be the accurate. So remember these 3 points as well. Got it? Is there any question? Are you getting it? Students, are you getting it? Now, advantages of NPV. The first advantage, it's a cash-based method. The second advantage, it considers the time value for money. Third advantage, it considers the total project life. Like payback period, it does not ignore the cash flow after the payback. It considers the whole life of the project. Number 5, we can relate the NPV with shareholder wealth. NPV is positive by $10,000. That means the shareholder wealth will increase by $10,000. That is an advantage. And number 5, it gives answer in absolute terms. It is not give answer in terms of percentages. It gives us answer in terms of dollars. In terms of dollars, absolute terms. It considers the size of the project. So these are the advantages of the NPV. And these advantages made the NPV the best method in investment appraisal. NPV is the best method. From all the methods, NPV is the best method in investment appraisal because of these advantages. It considers the cash base, it is a cash base, it considers the time value for money, it considers the total project life. We can relate the NPV with shareholder wealth. It gives us answer in absolute terms. Accounting rate of return is not a cash base. Payback is a cash base, but does not consider the time value for money. Discounted payback, cash base, consider the time value for the money, but does not consider the whole life of the project. Thus, we cannot relate it with the shareholder wealth. NPV, consider all the things. That's why NPV is the best. Okay. Yes, there are certain disadvantages of NPV as well. And the disadvantages of the NPV is that all the projections which we have made in this format, all the projections which we have used in this format of NPV is basically forecast. These are forecasts. These are not the actual value. The number of units to be produced and sold is a forecast. Sale price is a forecast. Inflation rate is a forecast. Tax rate is a forecast. Sale disposal value of the project is a forecast. The cost of capital which we are using is a forecast. These are not actual values. And the forecasted value we are using it is basically the main disadvantage of the NPV. But this disadvantage goes with all the techniques. Accounting rate of return is also a forecast. Payback period is also a forecast. Discounted payback period is also a forecast. Similarly, the NPV is also a forecast. That is the main disadvantage. Otherwise, it has more advantages as compared to other techniques. That's why I claim, or the financial managers claim, that NPV is the best method to appraise the product. Got it? Yes, students. Any question? Can you hear me? Students, can you hear me? Are you there?
Yes.
Okay. Do you people have any question? Okay, okay. Okay, students, we have discussed the format of NPV. Format of NPV. In coming classes, we will be using this format to solve the question, but that will be the format which we will be using. Okay. Hopefully, you have understand it. Recording is available. Rewatch it. Try to make sense. And in coming classes, we will be applying this methodology on a past paper, and you will get more better understanding when we will apply this methodology on a question. And hopefully, I will do a question in the next class on this topic. Okay. Now, I discussed the items which should not be included, like depreciation, interest payment, general and administrative overhead. And we discussed the advantages and disadvantages of the NPV. And we concluded that NPV is the best method to appraise the project, Okay. So now we will close the class. Now, in the next class, we will discuss internal rate of return, and we will be doing a question on the investment appraisal from the past paper. And when we will be doing a question, then you will get more better understanding of the net present value method or the format which we have discussed. Okay. So till then, goodbye. Take care. See you next week.